By the end of this video, you will learn how to measure risk in your portfolio and how to control it for any of the negativity that might happen going forward in the markets. How's it going, world? Michael EJ here, coming to you with another video so you can reach those financial goals and dreams by becoming the best investor you can be. If you're new to the channel, what is up? Mainly talk about building wealth through the stock market on this channel, and more so doing it by having differentiated ideas. I truly believe that if you want to beat the market, you gotta think differently than the market. So if you want to think differently, just make sure to subscribe, like this video, and let's get started. Now, after what just happened in the markets and just going forward, you need to think a lot more about risk management. I have to admit, I didn't think about it too much. Even with some of my stock picks, I didn't think about it as much. And now, after what happened, including to some of my picks over the past week, my eyes have opened, and now we need to rethink risk. Gotta rethink risk. Now, when I'm talking about risk, part of that is volatility. You know, just at any given point in time, will the stock be up or will it be down? Is it doing a lot of sideways movements to get up there, or is it going to come up in a smooth line? Yeah, that's important. But Seth Klarman and Martin of Safety best identified the true risk, which is loss of capital. Losing money, losing on a position, losing on your P&L. That's what you don't want. I mean, it doesn't, even if it doesn't do better than the market, at least you want to say, I made money on a name. And that's what we're trying to do. That's all we're trying to do. So that's kind of our focus. So in order to do that, we need to understand the risk of losing on our picks, any of our companies that we're invested in. And the best way to do it is to look at it on both the stock and the portfolio level. First, on the stock level, you got to go back to the return drivers. I've stressed this time and time again. It's all about looking at the return drivers in your portfolio. Three main ways to get returns. You got to look at dividend yield, earnings per share growth, and changes in the multiple. Now, let's look at each one just to identify if a stock is less risky or more risky than the overall market. First and foremost, look at dividend yield. If a company is paying a dividend, more than likely it's not as risky as the market. Like, let's just be honest, not as risky as the market. And that's mainly because if you're paying a dividend, you're kind of committing yourself going forward. Like you can't cut it down, by the way. This is in Europe. In the US, if you bring down your dividend, the stock market will crush you. Like, if you're committing to pay a dividend, even flatline or increase it incrementally over time, you're saying we are comfortable in our own skin. We know we can produce the cash going forward to pay it. That is a really safe company just by itself. Because even though the dividend yield on the S&P 500 is 2%, you actually look at each of the individual companies, not a lot of them pay dividends. And some of them pay a lot of dividends. And sometimes that yield isn't good. Like, if you have a high yield, there's more to the story behind it. But that's another video. So overall, if you pay dividends, that's a great thing. It's an awesome thing to do. So keep that in mind. That's number one. Number two, in looking at the stock, you gotta look at earnings per share growth. Now, there's earnings and there's the per share part. So first and foremost, look at the per share part. You do not want diluted ownership. You don't want a company that's, unless it's justified. If it's a company that's investing in itself, I mean, you can't really punish them for that. If it's a young company and they don't generate enough cash, but you believe in what they're doing, you can't punish them for that. But if it's an older company and they're struggling with cash, or they're having, cash management issues, then punish them if they are like continuing to go back to the markets or even going to the debt markets to get cash. Vice versa, if a company's buying back stock, more than likely they're buying back at a reasonable valuation. Gotta watch out for that, because some companies just do it just because they got nothing else to do with the cash and they don't want to commit to dividends. So that's one of those iffy ones, the per share part. So keep that in mind. What's more important to me is the earnings growth. And I want good earnings growth. I don't want no sketchy earnings growth. You can grow earnings by just reinvesting more. I don't want that. I don't want that kind of earnings growth. I want quality growth, fundamental growth. The best way to look at that is look at the return on investment numbers. I am a huge fan of return on invested capital, but you have to make a lot of adjustments to get to that number. So let's just keep it simple and look at ROA, return on assets. I don't believe in ROE because book value can change a whole bunch of different ways. This isn't the 1960s and 70s no more. Book value is not a reasonable way to look at a company. So we're going to look at ROA, return on assets in general. If your return on assets are higher than the market, which about 7%, if return on assets are higher than 7%, that means your return on invested capital is probably above 10% or more. Really good. I mean, it's tough unless your company's really risky, you're probably creating value. And if return on assets are more like 12, 14, 15%, I mean, that means your return on invested capital is probably 20, 25, maybe 30%. It's even better. It's even more amazing. And I give a lot of credit for companies that have high return on investments, high return on capital. Also, you can't be out here missing earnings. Don't buy stocks that's out here missing earnings. Do not do it. Look over the past 4 to 6 quarters. Don't buy any stock that's out here missing earnings constantly. Because that means you have a questionable management team. You got the CEO manages expectations of the sell side, and the CFO works the numbers, some accounting tricks to beat numbers. Very easy, very simple. And if you got a company that can't beat them, I mean, the way a stock can crash is if they miss earnings. That's the number one way a stock can crash, missing earnings. Don't miss sell side. You can even buy side may be more optimistic, but they're not going to crush you. Missing sell side earnings will crush a company. So make sure they're not doing that. Lastly, change in the multiple or change in sentiment. It's a little tricky here, but I've identified a couple of ways that people look at the market after working with different investors over my short extended career. And one way is the size of a company. If it's a mega cap, you're safer because of mainly liquidity. I mean, yeah, it takes a lot to move the stock up, but it also takes a lot for the stock to come down. So size matters, especially for mega caps. Vice versa, if you're a small and mid cap, yeah, it doesn't take that much for you to come up, but it also doesn't take that much for you to fall down. So a little bit risky, watch out for those, especially for stocks that are under $1 billion. Next up, the industry or sector. Look, I mean, I don't believe technology stocks are as risky as they used to be, but they're still looked at as being risky, And then you got consumer discretionary names, risky because economic sensitivity. Financial, same thing, and that they just naturally carry a lot of leverage. The other side of that is utilities, really not risky. Like they're just going to keep chugging along. Same thing with consumer staples to an extent. Same thing in healthcare. Maybe not the biotech names or the names that that are really driven by trials and not actual earnings and driven by their financial statements. But for the most part, biotech, ex-biotech, healthcare is viewed the same way. Lastly, where is your PE multiple relative to the market today? Like if you're sky high PE multiple, it's risky because there's more opportunity to come down than to go up. One of the hidden ways to do well in the stock market is through multiple expansion. A lot of people don't talk about it. That's where a lot of your returns come from. Have you looked since the global financial crisis? Most of those returns, the stock market being up 300+%, yeah, most of that's through the multiple. I mean, that's the secret way of doing well. So you don't want to start off at a high point or too high of a point. And that's probably the one point I missed the most with some of my other stock picks. And that sometimes the multiple started off high and it wasn't 100% justified. Just because it's a quality company doesn't mean the valuation is justified. So that's one lesson I really learned. But, that's how you kind of contain risk on a stock level. Look at each individual part and see, is it less risky or more risky? And if you come out and you got little to no, return on assets aren't growing, you got a sketchy company that's missing earnings, they're a small cap, they're in a risky industry, multiples through the roof, run away. Or negative multiple, run away. Just stay away. Stay away. Those are the risky names. So, I have a video coming out about when to sell a stock, but in essence, whenever things get rocky, get out of those names first. Those are the number one names get out of. Now, let's look at the portfolio level. After you got your basket of stocks, how do you measure risk? How do you manage it? The best way I've seen to do it is to actually look at the return drivers, not just the numbers, but Why are you investing in this company? And are there a difference in themes, a difference in reasons? Are you in different industries? Are you looking at something different? I mean, you don't want to have a whole bunch of like 3, 4, 5 names that are going to be driven by the same dynamic. One big example of this is there's a lot of things going on in technology, AI, robotics. I have a video coming about with that for a couple of names to look into. If you buy all those names, they're all being driven by the same idea, same theme. Same thing with if you buy Amazon and Shopify and eBay, all driven by e-commerce. Pick one and have diversified themes in your portfolio. Don't be just invested in everything just because you like one certain idea. You like autonomous driving, you like AI, you like the cloud, you like financials. You gotta diversify from that perspective. That will really save you when the market really comes crashing down, because some names are going to suffer regardless. Now there is an X factor here, and the X factor is the amount of ETFs a name is in. There is one thing that hedge fund managers and money managers in general try to avoid, and that's crowded names, unless you have a differentiated view. If you're in a crowded name, watch out, because yeah, when times are good, it's all good. That crowded name is probably going to do well. It just is, because there's a lot of people buying. I mean, that's good. It's like my How the Stock Market Works video. If a lot of people are buying, more buyers than sellers, the stock's going to go up. But in rocky times or when the stock is going down, those crowded names tend to have a lot of speculators or a lot of investors that are easily spooked, or a lot of investors that were reaching for returns chasing, and they sell quickly. They just do. So you gotta just keep in mind of the crowded names. I mentioned before in my other video, and I'll put it down in the link below here as well, about that ETF database. Look at how many ETFs your stocks are in. If they're in a ton, like 150, 200 plus ETFs, watch out. Scary things could happen. It's just a thing to take advantage, just to look at, just to pay attention to. All else equal, get out of a crowded name before you get out of an uncrowded name. Just saying, when things get rocky, those crowded names, a lot of them might end up falling. And that's what I have for you all today. You gotta look at things at both the stock level and the portfolio level. I mean, you can't forget about portfolio management. A lot of people don't talk about that, but you need to consider both look bottom up and top down at your portfolio. Michael EJ here, helping you reach those financial goals and dreams by becoming the best investor you can be. And I'll see you in the next video. Peace.